We do have some data that's hitting right now. Steve Leisman is standing by with that breaking inflation data. Steve, what can you tell us?
Personal income 0.3%. Becky, that's a miss on the 0.4 that was expected. Expenditures, wow, big jump there, 0.7%. That's above the expectation of 0.5 on the important price indices. Headline at 0.4. And ex-food and energy at 0.3. So that is right in line. That's the one, the core that people are interested in. Year over year, the headline does tick down. It looks like 0.1 to 3.4%. And the core, just 3.7. So that is exactly in line. Really in line numbers, Becky. There had been some talk about whether or not this number would show something of a tick down below expectations because of the data yesterday, or the positive core PCE data in the quarterly GDP report we got yesterday. That was not the case. A touch light on income. I've got to figure out where that came from, but the spending number was strong, and I'll have to look. My guess is that the personal savings rate, yes, it did, I guessed right. It fell to 3.4%, running well below the average of 5%, 5.2% is the average of savings over the last several years. It is down. People are running or using savings to keep up with their spending. Whether or not that's a smart choice or not, I guess that's up to the folks that are doing it. Prices for goods were up 0.2%. Services, a strong up 0.5%. And one of the things we'll be doing as the morning goes by is calculating that super core number that Fed Chair Jay Powell looks at. That had been very, very well contained, 0.14%, but I don't know what it is in September yet because we have to calculate it. Becky?
Hey, Steve, let me just run through like a broad overview of this. If you have people who are spending money faster than expected, even as their incomes are rising slower than expected, they're taking down their savings by more than anticipated to keep up with that savings, that could tell you one of two things. Either people are feeling pretty good about this economy, or they are being forced to tap into their savings just to keep up with inflationary costs that are rising at a faster pace.
Right. And just to make it more confusing, there's a third possibility, which is that both things are true for different cohorts of people, right? There could be a lot of stress, for example, at the low income trend. You could have folks who are on the upper income part that are feeling comfortable with what they're making. The job security numbers we've seen, Becky, for example, in our CNBC All-America Economic Survey, have been pretty strong. People feel pretty good about their jobs and their job prospects. Among 7 financial, areas of stress that we polled about, job security was the least stressful, or the other way, people were the most comfortable about it. In that context, you might be spending more of your income, more of your savings in that regard. We also don't know the level of savings that people have. So it could be that people feel like I've got the money for the rainy day, and therefore I'm okay in this month spending a little bit more of my income. That is not to diminish the stress part of that explanation that you put out there, which is indeed people could be stretching to make things work. You still have relatively high inflation, not only high inflation, but you have a relatively, high price level. People are not quite used to that price level yet. Although one of the things, just to contradict myself very quickly here, one of the reasons that was put forward, why are consumers out there spending? Prices for some things may have come down, that may have induced some to come in and do some spending that they may have held back on.